Okay, good evening, everyone.
Good evening, sir.
So, the topic is third session of the ratio analysis. They will try to cover the activity ratios and the turnover ratios. So, which will be your live lecture on Sunday. As the orientation, we are trying to understand the pre-study concept. Okay, so which will help you to understand the main class live lecture from the examination point of view. So today, just I want to brief you about the discipline and the motivation. The difference between the discipline and the motivation. I'll just go through this video. Previously, we see the watch this video and try to understand and try to change the mindset. Okay. So this is happening here. This is happening here when we are involving, when we are motivating. At that time, full hard work is going on, and there is no consistency and there is no discipline the students are following. So try to be disciplined. Okay. So we'll not come to motivate on every time. And here we cannot open a new doors while holding onto the past. So what does it mean? We cannot open a new doors. So every Sunday, a new topic is the teaching. So now 2 to 3 Sundays are completed. Almost 1 month is going to be complete. So please complete your backlog, okay, before going to the new topic. Before going to the okay. See the graph, consistency. The confidence and the ego. Lack of discipline, pain of discipline, and the pain of regrets. Staying down won't give any results. So we need to fight back. Happening. Consistency Consistency leads to the success. So thank you very much for watching the video. And today we are trying to understand the learning objectives for the today's session is activity ratios and the profitability ratios. Activity ratios are also called as turnover ratios. I'm audible to everyone. I'm audible to all the students.
Yes, sir. Yes, sir.
So understand the concepts and importance of activity ratios. As our regular practice, we are understanding the meaning of the ratio, importance of the ratio, ideal ratio, formula, and step-by-step calculation of the ratios and interpretation of the ratios. So here we are trying to liquidity position we understood by solving the liquidity ratios. Debt to equity ratios, we understood the concepts. Now today we are trying to understand the concepts. That is called as evaluate the efficiency of the assets utilization in business operations. So we purchase the asset. Okay, we purchase the asset. But how much the asset we are using efficiently in the business today we will try to understand. How can we understand the efficiency of the business? Yes, it is quite simple, easy to evaluate the efficiency of utilization of assets. And here we will calculate, interpret the following ratios. Today, we will understand the inventory turnover ratio, debt, that is receivable turnover ratio, average collection period, creditors turnover ratio, working capital turnover ratio, fixed assets turnover ratio, total assets turnover ratio, and analyze how efficiently a company convert assets into a revenue. This is a beautiful sentence. By understanding this activity, what we are analyzing, here we are analyzing how efficiently a company converts assets into a revenue. If revenue is not generating, if we have the assets, what is the reason? And the fourth and fifth point is apply activity ratios for performance evaluation and decision making. Performance analysis evaluation. Why we are using the activity ratios? We are using the activity ratios and we are applying the activity ratios to check the performance evaluation and making the decisions. And the profitability ratios we'll discuss once we complete an activity ratio. So we have to go 2 hours now from now. The profitability ratios will be the continuation in the next class. That will be tomorrow or the next session on the Monday or Tuesday. So what will be the session outcome? You can analyze the business efficiency and you can understand assess the profitability and the performance of a companies using profitability ratios, interpret the ratios results in the managerial and investment decisions. Okay. So apply the ratio analysis techniques to real world financial statement and the case studies. So these notes are fully designed in the descriptive model with the examples and the simple language. This material will be useful in your day-to-day professional life. This material will be with you always. Okay. If you have any doubt in your real life, in the real world, in the office, you can refer my material. Okay. This is purely a practical material, not theoretical, not from the examination point of view. This material is developed fully practical for the office oriented purpose for the real world financial statement analysis purpose. Can we start? All of you?
Yes, sir.
Yes, sir.
You can start, sir.
So activity ratios or turnover ratios. So meaning of the activity ratio. What is the meaning of activity ratio? Activity ratios also known as a turnover ratio. So Mushraf, what is the alternative name for activity ratios?
Turnover ratio.
Excellent, very good. So it will measures activity ratios measures the efficiency and effectiveness with which a business utilize its assets and the resources. So by using the activity ratios, what we will measure, Chaitanya? What we will measure? We will measure the efficiency.
Efficiency and effectiveness.
Yes, efficiency and effectiveness of business, how it is utilizing the assets and the resources. And these ratios indicates how quickly the funds invested in various assets are converted into sales or the cash. For example, we purchased the inventory. So what is the inventory cycle? What is the sales cycle? The quotation will come after 2 to 3 days. Operating cycle of the inventory, cash to cash. Operating cycle of the cash to cash. For example, by using the cash, we purchase the inventory and we save the inventory. After 2 to 3 days, we receive the quotation. The quotation is approved after 2 days. And we make the invoice. We deliver the goods in 2 days. Then we send the invoice with the 30 days, 40 days credit period. After 30 days, we raise the accounts receivable department. Then they've given the PTC check or a current dated check. We realize the check. So like this, it will take cash to cash. We invested cash. When we will get back the cash? So funds invested in various assets and converted into sales and cash. What cash we invested into the business, when we will get back that cash? That's what we are trying to understand by applying the activity ratios. In other words, activity ratios shows how efficiently management uses inventory, receivable, fixed assets, and the total assets to generate a revenue. So inventory, how? What is the strategy? They are playing to generate a revenue effectively. We can understand here. So what is the definition of the activity ratios. Activity ratios measure the speed. Activity ratios measure the speed at which different assets are converted into sales and indicates the efficiency of assets utilization by the business. Activity ratios measures the speed. What is the speed? How much speed the assets are converted into the sales. And the efficiency of assets utilized by the business. That's what we are trying to understand. And what is the objectives of the activity ratios? Activity ratios. The objective of the activity ratio is to evaluate the operational efficiency. Operational efficiency and to measure the speed of conversion of assets into sale. This is a very, very important point. The objective of the activity ratio to measure the speed of conversion of assets into a sale. And activity ratios are to assess the effectiveness of assets management. It will use to assess the effectiveness of assets management. And activity ratios we are using or we are applying to identifying the idle or underutilized resources. Underutilized resources. For example, we appointed 2 staffs. Still one staff is, we told that after 2 days you can join. Or one staff, we are not utilizing his full time or full capacity. So like this, we can identify by using the activity ratios, we can identify the idle and unutilized resources. And activity ratios are the objective of preparation. Objective is applying the activity ratios to compare the performance with the previous year or with the industry standards. Industry standards. This is the performance evaluation efficiency. You can compare with the previous year to industry standards. Industry standards. So what are the objectives, Chaitanya?
To evaluate operational efficiency and how much the speed of that using the assets to convert it into the sale. And how effectiveness of using the asset management. And we need to see how much the resources which are underutilized.
Very good.
And to compare the previous years with the industry standard or industry.
Very good. Thank you, Chaitanya. Mushraf, what is the meaning of activity ratios?
Sir?
What is the meaning of activity ratios?
Activities ratio, no. Meaning, sir?
Yes, meaning.
Meaning. Sir, to utilize asset of the business, sir.
No, wrong answer. What is the meaning of activity ratio?
Yes, sir. Measure the efficiency of effectiveness of the business, how they utilize in the asset. In other words, activity ratio shows how efficiency management uses inventory receivables.
Very good. Now, Mushraf again. What is the meaning of activity ratio? So it will not measure the assets. It will measure the efficiency or effectiveness of the business, how they are utilizing the assets and the resources to generate a sales. Generate a sales. So importance of the activity ratios. Importance of the activity ratios. So the objectives and the importance of the activity ratios. Very, very important. Okay. These are the very, very important points. These are the very, very important points. So what is the importance? Why we have to calculate these important ratios or not important ratios? It's important ratios because it measures the efficiency of the management. What is CMS? CMS stand for last time? Management, right? So here you are checking the efficiency of the management. What efficiency will check the management? How the management utilizing the assets and the resources which we provided to them to generate the revenue. And activity ratios are helping in improving the working capital management. Working capital management. And activity ratios assist in credit and investment decisions. How much credit we can give, how many days credit period we can give. What is the value of the amount we can give on the credit? Can we invest in this company or not? So these are the important points. And the fourth one is indicates whether the assets are being properly utilized or not. Assets are utilizing or not properly, and improve the profitability through the better resource management. And always it's improving the profitability through the better resource management. If you want to increase my profitability of my business, what I have to do? How to bring the better resources. Management. So we can understand the importance of the ratios, or it will measure the efficiency of the management. It is helping in improving the working capital management. It's assisting in credit and the investment decisions, indicating whether the assets are being properly utilized or improve the profitability through the better resources management. So Chaitanya, it is important to important to learn these ratios. It will be useful in our day-to-day life, or simply we will complete the syllabus. Is it important to learn these ratios very practically or no? Chaitanya? Twice?
Yes, sir. It will be
It's
very
important.
important to our.
By keeping in mind the objectives and the importance. So now we understood what is the objective, why we are learning the activity ratios, and we know the objective, why the companies will calculate the activity ratios, and we understood these are the very, very important ratios. Okay, so now we understood the meaning of activity ratio. We understood the objectives of activity ratio. We understood the importance of the activity ratios. If it is not important, we'll not learn. Why it will be in the syllabus? It is there in the syllabus. And I believe if you know the meaning, if you know the objective, if you know the importance, so we will work hard on these ratios, because these ratios are measuring the efficiency of the management, not the employees, not the department. So once you are a TMA expert, so what you will do? You will work above the management to understand their efficiency. So this is the importance of the CMA designation, a qualified CMA, a certified CMA position. The major activity ratios are, the significant activity of turnover ratios are inventory turnover ratio. That means we'll see the efficiency of the management, how they will convert inventory is an asset. So how quickly, how much speed they will convert this inventory into the cash. Means within how much time, within how many days they are converting. Means how much stock we need to buy, how much days we need to keep the stock. We'll understand. Receivable turnover ratio. So how many days credit period we have to give? 30 days, 60 days, 90 days. Generally, what is ideal ratio? We'll understand today. We are an accountant. When you are as an accountant, when you are creating the ledger, if you are using Tally, Zoho, or any type of ERP, when you are creating a customer ledger, there is a field will come, number of days. So you will go to the sales team or you will go to your manager and you will ask, sir, how much days I have to fix? 30 days. He will tell by the experience or by the relationship. But once you learn this ratio, you can decide and you can advise to the management. So how many days you can fix? And how much, what is the average collection period ratio? What is the average collection period, which I discussed with my management? So when the students will pay, how many days we can allow the students to pay the fees? And creditors payable turnover ratio. How many days we have to pay, when we have to pay, what we have to pay? Simply we will answer, no. We will evaluate these ratios in our mind and we'll advise our team to proceed like this, proceed like that. So we are not simply we are saying anything by our own. No, we are implementing the ratio. We are utilizing the full concept of the ratios to always we are trying to develop our business. And here working capital turnover ratio. Even though we may have the proper working capital calculation, sometimes we'll go into the negative class cash because of unexpected cash flows. Payments will come or delay in the receivable or advance payments which we agreed that we'll pay after 2 months, but because of the emergency we are paying. Then we'll understand. And fixed assets ratio and the total assets ratio. So let us begin the analysis of each and every ratio, the meaning, the importance, the objectives, the what is the ideal ratio to decide whether this asset is performing good or not. Are we ready to understand, to analyze the performance of the management? Students, are you ready?
Yes, sir.
Yes, sir. We are ready, sir. The first one is an inventory turnover ratio. This is also called as a stock turnover ratio. So meaning, we need to understand the meaning. Chaitanya, what is your name meaning? Chaitanya means what? There is a meaning to the name, right? Every name have a meaning.
Chaitanya, are you there?
Yes, sir.
What is your meaning of real meaning?
Uh, I don't know, sir.
Huh?
I think I inspire the people. I don't know exactly the
But that we
meaning.
need, right? Chaitanya. Chaitanya Vandudu Kavali antaru. Avuna kada? So successful.
Yes, sir.
Okay. The thing is that called as a successful, the meaning the Chaitanya means. Okay. So here, inventory turnover ratio, also known as a stock turnover ratio, it will indicate the number of times is inventory converted into sale during a particular period, usually in a 1 year. In 1 year, how many times inventory came and gone? For example, we decided to purchase 50 kgs and sell of any material. For example, we decided to purchase 25 laptops, 25 computers, and we have to sell. So inventory turnover ratio will decide how many times in a year we purchased and we sold. It's very, very important. Yes or no? So this ratio helps in measuring the efficiency in which the business manages inventory and utilize the funds invested in stock. Invested in stock. For example, I taken the loan 200,000. I purchased the inventory and I sold for 250,000. So can I utilize 250,000 full or no? No, because 200,000 I purchased from the supplier by investing. Again, I have to 200,000 I cannot touch. Only 50,000 of the profit which I received that I can enjoy the amount. So here we will understand the management and its inventory and the utilization of funds invested in stock. And for example, suppose a television dealer maintain an average stock of only 25 TV sets in the showroom. Means here in the showroom, he will maintain only always stock of 25. As the TVs are sold, a fresh stock is purchased continuously. Means every day minimum 25 inventories he has to keep in the warehouse, in the showroom. So today they sold 5 TVs. So immediately he need to buy 5 TVs. By doing so, the dealer may sell 150 television sets during the year, although the inventory held in is only 25 TV sets. He sold 150 TVs, but always he will hold 25 TV sets. So what we are trying to understand, maybe we are asking the owner of the management, sir, how much stock you will maintain every time? So he will say 10 kgs of sugar I will maintain. Okay. How many kgs of sugar you sold in total 1 year? Sir, I sold 150 kgs of the sugar. And you have the 25 kgs? Yes. That means how many times he purchased the sugar? 6 times. So in the given example, how many TV sets he will keep in the showroom? Mushraf, how many TV sets he will keep in the showroom?
25, sir.
25. How many he sold?
Like 150
150
during the year.
during the year. So how many times he purchased?
6 times.
6 times. So what we understood here,
They have to, some lot will be keep it with the company for the business.
So this means that the inventory has been sold and replaced 6 times during the year. How many times he bring the inventory, fresh inventory of 2025? 6 times. Like this, we are understanding the ratio. The definition of the inventory turnover ratio, inventory turnover ratios measures how many times the average stock. What is the average stock in the given example? 25. Average stock in the given example is 25. Is converted into sales during the year and reflect the efficiency with which funds invested in the inventory are utilized. So he invested money for 25 TV sets. How many times he converted 25, 6 times in a year? So what is the formula for the inventory turnover ratio is equals to cost of goods sold divided by the average inventory. What is the formula, Faiz, for the inventory turnover ratio?
Cost of goods sold
Cost of
divided
goods
by
sold divided-
average.
Mariam, what is the formula? So now we understood the formula. Inventory turnover ratio is cost of goods sold divided by average inventory. What is the meaning of cost of goods sold, Mushraf?
Sir, cost of goods sold, sir.
Yes.
The operation expenses we will get from the turnover, sir, which is a direct expenses, indirect expenses, which is the operating expenses. Then we will calculate by the sales, like how much turnover we are taking during
That
the year.
is again, that is absolutely a wrong answer. Kashif, may I know what is the formula for cost of goods sold? Kashif, are you there? Chaitanya, what is the formula for cost of goods sold?
Sir, opening stock plus purchases. Sorry.
Girish, what is the formula for cost of goods sold? Girish,
Sir, beginning inventory plus purchases minus ending inventory is cost of goods sold.
okay. So where the cost of goods sold is equal to sales minus gross profit. Sales minus gross profit is the cost of goods sold, as well as what is the average inventory? Average inventory is equals to opening stock plus closing stock divided by 2. Average means opening, closing, highest, lowest by 2 is called as always a average inventory. So what is the formula for inventory turnover ratio? Inventory turnover ratio is equals to cost of goods sold divided by average inventory. Cost of goods sold is equals to sales minus gross profit, and the average inventory is equals to opening stock plus closing stock divided by 2. All of you, please write down the formula. We'll solve the questions and we'll interpret the ratio and we'll give our comment also. Try to understand the efficiency of the management, how they are utilizing the funds invested in the inventory. Done. Formulas are done. All of you, Mushraf. Mushraf, what is the formula for cost of goods sold?
Sales minus gross profits, sir.
Price, what is the formula for average inventory?
The opening stock plus closing stock divided by 2.
Very good. So can I move forward? Any doubt in the inventory turnover ratio? Are you understood? What is the purpose of calculating the inventory turnover ratio?
Sir,
Why
one
is that?
doubt.
Yes, tell me.
Cost of goods sold formula is like opening stock plus purchase minus closing stock, right?
No, this is a new formula. Like there are different things will come. Sometimes we need to find out the sales. In the question, they will give cost of goods sold and the gross profit. Suppose. We'll go through. Okay. Give the formula. Already we completed, Mushraf, the cost sheet, first chapter. Why you are not revising? Why you are getting
Sir, production cost, that one. Factory
Huh?
cost rates.
prime
Complete.
cost? When you are calculating the prime cost, we discussed. You are not revising. You are wasting your time. Your efficiency evaluation we will do now. You want to revise. The only success in CMA is the consistency. Daily revision, 5 minutes, half an hour. 2 minutes. I'm telling every day to go home 6 o'clock and read. You will not understand now. After 4 or 5 Sundays, okay, you will lose the track. This is now only one chapter. Next, I will complete. Tomorrow, I will complete. Next week, I will take 4 or 5 orientation classes to complete the syllabus. How you will prepare? Here, we done a lot of strategical hard work to launch weekend classes because people are working professionals. I know the office stress, office, responsibilities, client responsibilities, everything is there. If you invest full time without discipline, I shown you the discipline video also. So please take yourself time every day, half an hour, 1 hour, 2 hours, no disturbance, dedicatedly lock yourself in the room or a library, sit and revise. I'm not telling you to do any other hard work. Take my PPTs and revise. That's more than enough to clear the UCMA exam.
Okay, sir.
Only hard work in your life till October, I'm asking. Then after you will be at the next level, your life. Okay. Don't waste your time. Stock turnover, stock conversion period. Stock conversion period. Inventory turnover ratio may also be expressed in terms of number of days required to convert a stock into sale. I will ask every day, Faiz, how many days you will take to complete this work, right, Faiz? I will ask her no.
Yes, sir.
So what is the concept of our company is, once the work is completed, we'll raise the invoice.
Yes, sir.
Right. So here we are trying to understand how quickly we can convert our service into sales. This is called the stock conversion period. So we can say the service conversion period. That's why sometimes we'll decided we'll finish this because we need a funds. So how quickly we can complete, we can convert the services or the stock into the sale is our always an objective. If you follow the management instructions on a daily basis. Why he said, from where he said, means I'm telling from my subject point of view, I know how to run my business. How, from where I learn under the supervision of the seniors, as well as always I try to apply the subject into our business. Formula for the stock conversion period. Stock conversion period 365 divided by inventory turnover ratio. What is the formula for inventory turnover ratio, Faiz?
Cost of goods sold divided by average inventory.
So simply he will ask you the portion stock turnover period. So indirectly you need to calculate the inventory ratio. You are trying to understand the link between the ratios. He will not ask you to calculate the inventory turnover ratio. In the question, he may ask you to calculate the stock conversion period. That means indirectly you need to calculate the inventory turnover ratio. Mushraf, what is the formula of stock conversion period?
365 divided by inventory turnover ratio.
Excellent. Chaitanya, what we are understanding by calculating the stock conversion period?
Sir, by seeing this formula, we can understand that how many days you can convert your stock into the sales.
Excellent. Without purpose, don't mug up. This is you are learning to perform your day-to-day duties in the company once you qualify. The importance of the inventory turnover ratio. The first importance is it measures the inventory management efficiency, indicates how efficiently management controlling the inventory levels. Inventory levels, minimum level, maximum level, danger level. These are the stock reorder level. These are the levels how the management effectively managing the inventory levels. And how efficiently we are managing our services levels. We are prioritizing daily, which are important to focus today, and we are sending some clients tomorrow. And it avoids the excessive investment in stock. This is a beautiful sentence. Right. So it will not allow you to invest unnecessarily, block the stock. So the proper turnover ratio ensures the unnecessary funds are not blocked in inventory. Not blocked in inventory. Improve the liquidity. So fast moving inventory convert into the cash quickly, improving the working capital. So this is the importance of the inventory turnover ratio. So you can see some software dashboards. A separate tab will be there for fast moving item, first 5 fast moving items. And some software dashboards will show top 5 receivables, top 5 payables. Why? These are the issues to understand the business, improve the efficiency. Improve the efficiency. Reduce the storage and carrying cost. The items are getting very cheap, sir. Can we buy? No. No need. Where we will keep? to take a big warehouse. So material you are getting at a cheaper price, but we have to pay warehouse cost. As well as if you are bringing the inventory many times, transportation expenses will increase. To save the material cost, to save the transportation cost, you have to you have to pay the warehouse rent is very high. So economic order quantity. So by calculating, by understanding the inventory turnover ratio, it will help you to reduce the storage and the carrying cost both. It will not allow you. So lower inventory holding period, minimize the warehouse, insurance and maintenance cost. And fourth point is reduce the storage and carrying cost 2 times. So fifth point is helps in purchase planning. Management can determine the amount of inventory required to achieve the desired level of sales. Desired level of sales. So our sales target is like 1 million in a month. So here we'll decide how, sir. Okay, you said 1 million sales we have to do. But how much inventory we have to buy? Because the inventory has to come from China. How many days it will take to come? So inventory should be ready to sell. So this type of management decisions you can take easily, helping in purchase planning. And it will indicate the business performance. A higher ratio generally reflects the better operational efficiency. How much high ratio for the inventory ratio that will show your operational efficiency. So ideal inventory turnover ratio is 8 times. Ideal inventory ratio is how many times? 8 times. So an inventory turnover ratio of 8 times is generally considered satisfactory. So minimum 8 times you need to rotate your stock. If you are not in a position to rotate your stock, so there is a problem. You cannot convert the sales. More than this, yes, very efficiently and very effectively you are doing the business. Interpretation. So what is the ideal time? 8 times. Higher the inventory turnover ratio indicates fast moving inventory. Fast moving inventory will help in converting the inventory into the cash fast. That will help in managing the efficient working capital. Efficient inventory management, lower carrying cost, better liquidity. This is the importance of this ratio. Higher the inventory turnover ratio, better liquidity. Higher the inventory turnover ratio, lower carrying cost. Higher the inventory turnover ratio, efficient inventory management. Higher the inventory turnover ratio indicates the fast moving of inventory. However, an extremely high ratio may indicate understocking, frequent stock replenishment, loss of sale opportunities due to the extremely high. Again, that will be a problem. Low inventory turnover ratio, slow moving inventory, excessive funds blocked in stock, risk of obsolescence, higher storage cost. Highest storage cost. So key points for the CMA student. So higher ratio, higher turnover ratio. Why I added this for a special point? Because the examination pattern is changed to case studies. He will give you the scenario by saying in this company, the inventory turnover ratio is showing high, not extremely high. It will show high. Then what will be the effect of the high turnover ratio? Option A, slow moving inventory. Option B, lower carrying cost. Option C, high storage cost. Option D, better liquidity. So your answer is B and D. So your higher turnover ratio generally indicates the better inventory management and efficient utilization of funds invested in stock. However, an excessive high ratio may result in stock storage and loss of sale opportunities. Clear? Useful? Understood? Let us calculate the inventory turnover ratio. I'm expecting answer from Mushraf. Inventory turnover ratio, can you calculate, please? If you want formula, maybe all of you, please calculate inventory turnover ratio. Chief, are you understanding the class? No problem, Kashif. All the classes are recorded. Okay. We'll do some extra efforts with you and we'll take a separate class. Inshallah, we'll merge you in the same batch. No worries, that's my responsibility to give you back the two units. If you promise me to work hard, I will promise you that we will also work hard for your success. So what is the answer, Mushraf? You got the answer?
Yes, sir. For first inventory turnover ratio, we calculate COGS, sir, which is sales minus gross profit. 12,000, sir, minus 3,000. It will be 9,000. So the COGS is completed. Next we'll go for the sir.
Yes. So step number one, you calculated the COGS, sales minus gross
sir.
profit. So here, the opening inventory, closing inventory, you didn't touch. So this is the next step number two. You calculated
Average.
the average inventory. What is the
Inventory.
formula for average inventory? What is the answer? Average inventory price. Thank you, Mushraf. What is the price? What is the answer for step number two? Price, you went for dinner.
I was speaking. 1,500.
1,000.
Total answer is 6.
Excellent. So 1,500 opening inventory, 1,400 plus 1,600, 3,000 divided by 2. So Chaitanya, what is the inventory turnover ratio now? What is your answer? Chaitanya. Girish, what is your answer?
Sir, 6 is the answer. Inventory turnover ratio 9,000 divided by 1,500. That will be the 6 times.
Okay, 6 times. Is lower or higher? What is your interpretation? We understood, right? Interpretation, high inventory ratio or lower inventory ratio. And we know the ideal ratio. How much? 8 times, right? So now
Yeah,
the
ideally is 8 times. So this
This
is
is
6 times.
6 times is higher or lower?
It's lower.
So what is the comment? What is the interpretation? What is the comment? What comment you will write? The management is the movement of inventory is very slow. The management block the funds, excessive funds in the stock.
Risk of obsolescence.
The
The
management is
higher
paying
storage.
higher storage cost because the movement has to go very speed. They're not doing speed. That's why only 6. So the inventory is sold and replacement 6 times during the year. So we know the interpretation results. Why is any doubt? Are you understanding the concepts? Then now you are understanding the concept, Alhamdulillah, but you need to increase the speed. How the speed will increase? By practice. Every day practice the syllabus and prepare a chart with all the ratios, inshallah. I will give from my side, but you should put your efforts, make a separate by yellow color, blue color charts. Write down all 1, 2, 3, 4 ratios. Liquidity ratios, leverage ratios, activity ratios, profitability ratios. One column, one chart, one paper, finish. Can I jump on to the next slide? All of you clear? Chaitanya, are you clear? Yes. Can I jump on to the next topic? Mushraf, Faiz, Chaitanya, Kashif,
So yes, sir. Yes, sir.
any
Sir,
doubts?
can I? Yes, sir. I have, sir. Can I ask?
Yes.
Sir, why sir COGS is different from every formula? There is in specific definition here.
See, this is the student, the question will come in like anything. You must know how to arrive the costs. There is no
Yes, sir.
fixed formula. You must know the profit and loss account income statement. You must know your income statement. By solving the number of problems, you can understand how varieties of questions will come. The scenarios will come. So now, the stock conversion period. Now find out the stock conversion period. What is the formula for the stock conversion period? 365 divided by inventory turnover ratio. Means 60 days. Stock conversion period is approximately 61 days. On average, the inventory stock approximately 61 days to convert into cash. Very bad. 60 days. One time the recycling is happening on 2 months. Okay. Illustration 3. Illustration 3. Please calculate cost of goods sold, inventory turnover ratio, and the stock conversion period. Stock conversion period 365 divided by inventory turnover ratio. Please calculate. Who will give the first answer? Reward yourself by eating biryani today. Who will give the first answer? See the Mushraf. In the previous question, they given the value of gross profit. So simply you done 25,000. But now here, you can't say that why like this, sir. You must know the concept. Chaitanya, you got the answer?
Sir, gross profit will calculate from sales, sir.
I don't know.
Okay, sir. Okay.
Try. Percentage of gross profit. Inclusive of what, exclusive of what, you understood?
Yes, sir. Understood.
Try to apply the formula here.
Yes.
Sales included gross profit or sales will not include the gross profit?
Yes, sir. Sales is included gross profit, sir. I think
So
if we divide, if we multiply 25 divided by 100.
Try karo.
Yes.
Try karo.
Yes, yes.
Here, this is practice, Mustafa. You can do any number of time mistakes. Right? What video we seen in the beginning? Try, go on mistakes, no problem. Mistake. You will reach one day the success.
Yes.
If you are afraid to do the mistakes, you will never be succeed. Five.
Sir, the answer is 3.
Answer is 3 from 5. Chaitanya, what is your answer? 3 of inventory turnover ratio 3. 3 days or 3 times? 5. 5.
Sir, yes, sir.
3 times or 3 days? 3 for what? Cost of
3
goods or
times. 3 times.
3 times means inventory turnover ratio. Okay, 3 times.
Inverted turnover.
Is high or
Sir,
low?
5 times, sir.
It's high or
Low.
low? Low means it's good or bad?
Bad.
Yes.
So,
Okay,
final answer is
Sir,
What do you
5
mean?
times, sir.
5 times. So it's high or low?
Low, sir.
What is the problem? Is it good or bad?
Bad, sir.
Very good. Chaitanya, come on, speed. We have a lot of ratios to complete. Chaitanya, it's not there. I think he left. Okay. Girish,
5 times, sir. 5 times.
5 times. So 5. So gross profit is 20,000 multiplied by
25.
5%. Gross profit is 5,000. So 5, what is your gross profit?
same, sir. But
Okay,
I
very
didn't
good.
write, but
So what is your average stock?
15,000.
So here,
So,
profit is 5,000. And step 2, calculate the cost of goods sold. So gross sales minus gross profit. So step number 1, first you need to calculate the gross profit. In the previous example, in the question, the examiner directly given you the gross profit. But here in the examiner is given percentage of gross profit. So percentage of gross profit is sales multiplied by percentage of gross profit. So what is your Cost of goods sold 15,000. So Faiz, what
Yes,
is
yes,
your
yes.
cost of goods sold?
Yeah, yes, sir. Because I got to that one, but final time when I calculate 5,000 instead of 3. Sorry, I calculated 5,000 instead of 3.
Okay. You understood your mistake?
Sir, I got it.
Okay.
Because I didn't write down the steps.
No, you need to do the steps and you need to write down the formula. So don't do the calculation directly on the calculator. No, never. This is a learning stage. No? This is on day 1. So you need to write the formula number of times. Follow the steps. I'm giving you the step by step because sometimes you calculate that first one. No. Simple procedure. We'll go step by step each and every formula. You need to increase the steps speed. That's it. So now 5 times is the right answer. Good Mushraf and good Chetan, what it is called Girish. So the first answer given by Faiz, but unfortunately wrong. And Mushraf is given the right answer. Very good, Mushraf.
Thank you, sir.
Next is calculation of the stock conversion period 360 divided by 5, 73 days. In the previous question is 61 days. Okay. So interpretation, the inventory sold and replaced in 5 times during the year. How many times they purchase and sold the inventory? 5 times in a year. And on average, inventory remains in stock is 73 days before being converted into sales. So how many days the stock will be held in the warehouse? 73 days. A higher inventory turnover ratio indicates efficient inventory management and the faster conversion of the stock into the revenue. Clear? Any doubt? Can we go to the next formula? All of you clear the inventory turnover ratio?
Yes, sir. Yes, sir.
Stock conversion period, inventory turnover ratio. Can we close the formula? All of you? Mushraf,
Yes, sir.
Faiz,
Yes, sir. Yes, sir.
Kashif, Azam, Chaitanya, are you there or no? Okay.
Yes,
Next
sir.
ratio.
Yes, sir.
Okay, what is the next ratio, Mushraf?
The debtors turnover ratio.
Also called as receivable turnover
Yeah.
ratio. Let us understand what we will analyze by calculating these ratios. The meaning is debtors turnover ratio are also known as a receivable turnover ratio. Inventory turnover ratio measures the efficiency of the management, how they will utilize the invested funds in inventory. Here it will measures the efficiency with which a business collects cash from its credit customers. It shows how many times debtors are converted into cash during the year. 1, how many times inventory converted into the cash, and how many days average inventory will be held in the warehouse. Inventory turnover ratio. Debtors turnover ratio, how many times debtors are converted means how many times they paid in a year. Higher the ratio indicates efficient credit collections. Many times they paid means fast they are paying means yes, very good. Your working capital will be efficient. And better liquidity, where a lower ratio indicates slow collections and excessive funds blocked in receivables. So you are not authorized to block your funds in the inventory. You need to do the inventory. You need to do the business, the fast moving items. You need to understand which items are moving very fast, which items are moving slow. Debtors turnover ratio express the relationship between net credit sale. Net credit sale means after sales return, right? Credit sale and average debtors. Average debtors, there we calculated average inventory because we need to find out the inventory turnover ratio. Here average debtors means opening debtors plus closing debtors by dividend. Indicates the speed at which the debtors are converted into cash, where inventory turnover ratio indicates the speed, how much fast they converted inventory into the cash. Here, this ratio is helping to understand the speed, how much speed the debtors are converted into cash. Understood? Easy now? How it becomes easy? By comparing. You need to compare. You must know the importance of that ratio and this ratio. Use of that ratio and this ratio. And you must remember, higher that ratio, what is your comment? Below that ratio, what is your comment? Below this is the scenario. Make it very simple. Don't get complicated. What is the formula for inventory turnover ratio? Cost of goods sold divided by average inventory. Here debtors turnover ratio is equals to net credit sales divided by average debtors. Mushraf, is it easy or tough?
Yes, it depends upon sir, because if net credit has a formula, average debtors has a formula. It will be same question like before.
Yes, where net credit sales is, I'm giving everything. I'm not expecting anything from anyone. In my material, you will get all answers for what questions you will get. You have in your mind, we are teaching the same chapters from last 20 years. I know the effectives of each and every student from the last 20 years. What they used to ask, you will ask the same. But now we are going in a very fast track classes. So that's why I'm presenting everything. I know you will not get a time to prepare a notes because you are working professional. That's why I'm giving you a detailed descriptive note with a very simple terminology. Now you are traveling in metro, just browse my PPTs. When you are eating, browse my PPTs. Where you will spend more time on lunch, browse my. Where you will spend more time in the washroom, browse my. Don't watch TikTok. Don't go for Facebook now. I'm giving you the PPTs for the revision, PDF, I'm giving you the revision. Clear what is net sale? What is the formula for net credit sale? Credit sale minus sales return.
Credit sale minus sales return.
If information regarding the credit sales is not available, then total sale may be used. Mushraf, what is the meaning here? In the question, it will give you the credit sale clearly. If not given, total sale will be treated as credit sale. Clear, Chaitanya?
Okay. Sir.
Yes, sir. Yes, sir.
Average debtors. What is the formula for average debtors, Girish?
Opening debtors plus closing debtors divided by 2.
Very good. Opening debtors plus closing debtors divided by. So now we understood the concept. We'll move forward fast. So note, debtors includes accounts receivable, bills receivable, accounts receivable, bills receivable. Data should be taken at gross value without deducting provision for doubtful debts. Excellent point. We completed 3-4 questions from your examination material. 4 points, 4 questions finished. Data includes accounts receivable, bills receivable, and always we will take gross value of the debtors, not the net value of the debtors. You need to take in the exam, in the question, he will give you debtors minus debtors 10,000 minus provision of debtors 2,000. And the answer is 8,000, which you will take 10,000 or 8,000? 10,000.
10,000, sir.
Because the concept is saying to use gross value, not gross. And if the opening debtors are not available, closing debtors may be used. Clear? This is called spoon feeding. Nobody will teach at this level. You will go and doing, because this course is defined with the working professionals who is working in the industry since more than 2 years. You must know these debtors and creditors. See, you must know. Anyhow, so
Sir, one second.
yes.
So for practically, we can get it from any ERP software, same like Tally. When we
Sorry?
open the practically, it can be taken from Tally or any ERP software, same like we opened sundry debtors and we took the closing amount divided by 2. Is that okay? Is that
Yes.
right?
Yes. Every ERP will have an opening balance. No, without opening balance, how can we understand the present receivable? So
Yeah,
it can be-
like we can get the net, right?
yes.
Instead
Yes.
of taking opening and closing, we can also take the net, right?
Yes. But you can generate from the different reports. If you are going for a Udo or Zoho or QuickBooks, accounts receivable ledger is there. Okay, that will show the net values. But you can generate a report from the other MIS reports. It's a good question. Okay. And here debt collection period, there is a inventory stock. What is the formula? What is the formula here? Stock conversion period. Here, debtors conversion collection period. Average collection period. Average collection period. Debtors turnover ratio can also be expressed in terms of the number of days required to collect the debts from customer. And that will decide the number of days of holding or converting. Holding or converting. Stock conversion period, what answer you will get? 70 days. The conversion time, they will get the cash. Here, debtors collection period or average collection 360 divided by debtor turnover ratio. 360 divided by inventory turnover ratio. Easy. Formula is easy. Importance of the debtors turnover ratio. Measure the collection efficiency, indicates the how efficiently management is collecting the receivables. And improve the liquidity. Improve the liquidity. Faster collection improves the cash flows and working capital. Reduce bad debts. Prompt collection reduce the risk of non-payments. And evaluate the credit policy. Evaluate the credit policy helps the management to determine whether the credit policy is too strict or too level. Assist the working capital management. Efficient receivable management reduce unnecessary investment in debtors. And efficient inventory turnover ratio will help in helping in unnecessarily blocking the amount in inventory. Indicates the financial soundness. A higher ratio indicates the better financial health. Ideal ratio is 8 to 12 times. Same inventory also same. Generally higher ratio is preferred. Equivalent collection period 30 days to 45 days is considered as satisfactory. 30 days is okay. More than 30 days, 45 days, hardly you can give, not 60 days. 70 days. Okay. Interpretation, higher debtors ratio, faster collection of receivable, better liquidity, efficient credit management, and lower chance of bad debts. Low debtors turnover ratio, slow collections, excessive funds blocked in debtors, increased bad debts risk, and weak credit policy. Weak credit policy. Illustration given one. Please calculate. Net sales. They given directly a net sales. So please calculate debtors turnover ratio. Who will give the first answer? Please write down the formula. Put the values. Do the proper calculation. Don't use phones. Most of you must have your calculator. I can see you. Why you are doing in the mobile? What happened? Guys, Tirupati, are you there?
10
Chaitanya,
times.
done? What is the answer? Tell me fast.
10 times.
10 times?
Yeah.
More than 8 is good. Higher debtors ratio. Efficient management. No chance of bad debts. Very good.
36.5 days.
Sorry?
36.5 days. Right?
Mustafa, what is your answer? Chaitanya, Girish.
Sir, 10
10 times, sir. 10 times. 10 times, 37 days, approximately. 37 times.
10 times. Debtors turnover ratio is 10 times. Interpretation. A company collects its receivable 10 times during the year. Clear? Any doubt? Mushraf, what happened? Ashraf Ali. Debt collection period 360 divided by 10 times. So 36.5 equal to, that is 37 days. On average, customer takes approximately 37 days to pay their dues. Please solve the question. Sales, cash sales, sales return, opening returns, closing returns. Who will give the answer? Who already? Who will give the answer?
The 12 times or 31 days?
12 times and 31 days. Mushraf,
Sir,
Chaitanya, what is your answer?
sir, the net credit sales is 2 lakh.
Give me
The
the answer.
average debtors
What is
is
the turnover ratio? Debtors turnover ratio.
10 times.
10 times. Okay. Collection period.
36.5.
6 months. Girish,
Sir, 9.5, 9.5, 10 times, and the average collection period will be 38 days. 365 divided by 9.5, I'm getting, it will become 38 approximate.
step number 1, net credit sales. Sales minus cash sales. Okay. Then net credit sales is equals to 190,000. Correct?
Ah, yes, sir. Yes, sir.
Next, average debtors. Opening
20,000.
debtors plus closing debtors by 2. Average turnover 190 by 20,000. That is 9.5. 9.5.
So 38 days.
For debt collection ratio is 38.42. If you take 10, see the difference. Chaitanya, you took 10, right?
Sir, that yeah, I didn't consider the sale return. Sale return I didn't consider. Sorry, I didn't consider.
Sales return not considered. Five, you got a different answer, right?
Yes, sir. Because I didn't take the cash sales. I took sales minus sales return. So 240.
You need a credit sale. Debtors will come when you give the invoice on the credit, when the customer not free. Don't forget
But
that.
cash will consider.
Cash
sale.
sales, the cash sales का क्या है? We received the money, खलास. That is not material for decision making, right? This formula we are trying to understand the goods we sold, when we get the money. If you sold on cash, immediately you got the cash. What need to calculate these all ratios? If your business is doing on the cash sales, like supermarket, if there any credit sale is there, you have to calculate. If it's total business is on cash sale, only to calculate. Same time, if you are receiving cash, efficient working capital. You're not blocking funds in the, that's why the cash sales they will prefer. The higher debtors turnover ratio and shorter debtors collection period indicates higher the debtors turnover ratio, shorter the debtors collection period indicates the efficient receivable management. Okay, strong liquidity and efficiency credit control, whereas the lower ratio indicates. Clear? Any doubt? How many ratios we completed now? There.
Three ratios, sir.
Tell me first one.
Inventory turnover ratio,
Second one.
stock turnover ratio,
Third one.
debtor turnover ratio or receivable.
The fourth one.
Fourth one,
Debtors
I think
collection period. Debtors collection period, brother. Wow. Here, debtor collection period.
okay, sir. Yes, sir.
You're
I
not
thought it
calculating.
will come under comes the same ratio.
Then why you taken that track the conversion ratio? That
Yes.
also you need to conversion, you treat it as one, right? Why you said 3? In that case, you need to say 2.
Yes, sir. Yes, sir.
Stock
Stock
conversion
turnover.
is 4. Take it 4.
Yes.
Okay.
Yes, sir. Yes, sir. Different ratio.
Okay. Now can we jump? What we understood from the collection point of view, let us understand the payable point of view. Creditors turnover ratio or payable turnover ratio. Indicates the turnover ratio. No need to explain anything, right? There we understood how fast, how quickly we are receiving the amount from the customers. Here, how quickly we are paying to the suppliers. It indicates the relationship between the net credit purchase and average creditors. Net credit purchase means not the cash purchase. Okay, fine. This ratio helps in evaluating the efficiency of firm's payment policy and its liability to meet the obligations on time. Meeting the liabilities obligation on time will give you the very good relationship with your vendors and with your suppliers. Grish, मजा आ रहा नहीं आ रहा क्लास में? Enjoy, you are enjoying the subject or no?
Yes, sir. Yes, sir. Of course, sir.
Definition. The creditor's turnover ratio expresses the relationship between the net credit purchase and average creditors. Debtors collection period will give the relationship between the net credit sales and average debtors. It indicates how many times creditors are paid. That will indicate how many times debtors are paid. We received, we paid. Simple, simple. What is the debtors turnover ratio formula? Mushraf.
Sir?
What is the data? Where are you? Are you busy? Are you eating? Hungry?
No, sir. No, sir. Net is net credit sales divided by average debtors.
Net credit sales divided by average data. Excellent. Now slowly you are moving towards success, CMA success. There are 2 types of photos will come in our social media or in a newspaper. I will publish your photo in the both the scenarios. If you pass, I will say this is the roadmap of success. If you fail, I will display your photo by saying this is the roadmap to fail the CMA. Both methods will motivate. They will not do that way. They will not select that route map which road is going towards failure. Which road you will select, Mushraf? Pass roadmap or fail roadmap? Which way you will do? Fast and pass. Inshallah. What is your confidence now?
Sir, higher on this.
Inshallah, inshallah. So don't be lazy, don't ignore the subject. It's okay to hold some office pressures aside, keeping the pressures aside and focus on the CMA. You need to pass the CMA because when you're investing the time, you must get the result. Don't be, hunky must like take it like be it serious. You can't give the time for many times, right? We'll give the one time a quality of time and we'll finish the target. No diversions, nothing. Daily 2 hours after dinner to sit. Now where credit, you need the formula or no need? No need. Right? Net credit purchases minus purchase return. If there is no credit purchases given, total purchase you can use. Opening creditors plus closing creditors. Creditor includes accounts payable, bills payable. If average creditors are not available, closing creditors may be used. Very good question. This is a dangerous sentence. Average creditors are not available, and use the closing creditors will be the average creditors. Debt payment period. Creditors turnover ratio can also be expressed in terms of taken by the business to pay the debts. How much time? How much number of days taken to pay the debtors? It is called as debt payment period. 360 divided by creditors turnover ratio. Clear? Any doubt? Chaitanya, is easy or tough?
Sir, yeah, easily understanding, sir. Concept.
Very good. Average this leverage ratios and the profitability ratios, you need to give more attention. Remaining all are easy ratios. But the only thing is which we need to add, which we need to minus. So creditor turnover ratio importance, it measures the payment efficiency. It helps the management to work the working capital, manage the working capital, proper management of creditors, improves the cash flow. Indicates the credit worthiness, timely payment enhance the firm's reputation and the goodwill. Assess the financial position, shows whether the company is capable of meeting in obligations. The suppliers, the customers who are not paying, they will lose the reputation. Next time we will hesitate to provide the services if the payments we not received on time. If the student, every customer is paying on time, we are also prioritizing to give the quality of service on time. This is practically we do, right? So help the negotiate a better credit terms. If you are paying always on time, we can say that, sir, we are paying on net. Can you give me a good discount? Idle ratio, turnover ratio is 12 times or more, not 8 times, 12 times. It's simply a debt payment period, approximately 30 days. Receivable 45 days we can do. But here payables is only 35 days or less. Higher creditor turnover ratio, 12 times or more, indicates prompt payment to the suppliers, improve the business reputation, strengthen the credit worthiness. However, a very high ratio may indicate that the company is not fully utilizing the credit period availability and may not be getting the best credit terms. But if the supplier is giving 1 month credit period, take it, don't pay in advance. Lower credit turnover ratio indicates delay in payments, may signal liquidity problem, can adversely affect the supplier's relationship, may suggest inability to meet the obligations on time. Please calculate. Illustration 1. Calculate the creditors turnover ratio. Who will give the answer? Guys, Chaitanya, Girish. Twice,
12 times, sir. 12 times. 12 times.
12 times.
12 times.
Yes, sir.
So average creditors are
30, approximately 30 days. 30.4 days हो जाएगा. 36, 365 divided by 12. So it will be approximately 30 days.
Next is the working capital ratio. First one is the inventory turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratio. Working capital turnover ratio means measures the efficiency with which a company utilize its working capital to generate the sales or cost of goods sold. It indicates how efficiently the firm's short-term funds are being utilized to support the business operations. Inventory turnover ratio will measure how efficiently the management converting the inventory into the sales. Debtors turnover ratio helping in measuring how quickly the management is collecting the money from the debtors, and the creditors turnover ratio helping in measuring how quickly the management is paying the country creditors, the payables. So here, working capital ratio are helping and measuring the effectively how the short-term funds. Okay, higher the ratio generally reflect the efficient utilization of working capital. In all scenarios, higher the ratio is good. However, an excessive higher ratio may indicate over trading where the business is operating with the insufficient working capital. Definition: working capital turnover ratios measures the relationship between cost of goods sold and the working capital. Cost of goods sold are net sales and the working capital, and it indicates how efficiently the firm utilizing the working capital to generate revenue. Formula: working capital turnover ratio is equals to cost of goods sold divided by working capital. What is the debtors turnover ratio? Formula, Mushraf. Debtors means sale. Sales means credit sale. Debt credit sale. Divided by average. Alternatively, the formula is net sales divided by working capital. In the both the ways, debtors point of view, creditors point of view, this formula can be interchangeably used by keeping cost of goods sold by working capital or net sales by working capital. Working capital is equals to current assets minus current liabilities. Ideal working capital ratio is 5 to 8. The ideal ratio varies from industry to industry. Generally, a ratio between 5 to 8 is considered as satisfactory. Importance of the working capital ratio. It shows the efficiently current assets and current liabilities are managed. Indicates the operational efficiency. Higher the ratio reflects the better utilization of short-term funds. Help in working capital management. It assists the management in determining the adequacy of the working capital. Improve the profitability. Efficient use of working capital helps the maximizing the sales and the profitability. Assist the investors and creditors. Investors and the lenders use this ratio to assess the company's liquidity and efficiency position. Higher the working capital ratio, efficient utilization of the working capital, better operational performance, higher the sales generate per dollar invested in that working capital. However, an extreme high ratio may indicate the over trading, inadequate working capital, liquidity problem. Lower the working capital ratio, excessive investment in working capital, idle current assets, inefficient utilization of funds are lower profitability. Can you please calculate? Cost of goods sold divided by the working capital. Working capital means don't confuse with the average current assets plus current liabilities by 2. No. Current assets minus current liabilities. Very easy. Mushraf, give me the answer. 10 seconds. You to complete. Guys, what is the answer?
So 6.
6 times. Very good. Fixed assets turnover ratio. Fixed assets turnover ratio efficiently in which the business utilizes its fixed assets to generate a revenue. Inventory turnover ratio, fixed asset ratio. That will give the measures the efficiency, how the revenue is generated from the inventory. Here, how the businesses are utilizing the fixed assets to generate the revenue indicates how the efficiently investment in long-term assets, short-term funds, working capital. Land, building, plant and machinery, furniture, equipment, okay, being used to produce the revenue, higher the ratio, better utilization of fixed assets, and efficient management of the fund. Definition, fixed assets turnover ratio measures the relationship between net sales and net fixed assets. Working capital, cost of goods sold, or net sales divided by working capital. Creditors turnover ratio, net credit purchase and net credit purchase and creditors. Fixed assets turnover ratio is equal to net sales divided by net fixed assets. Net fixed assets is equal to gross fixed assets accumulated depreciation. Component of fixed assets, land, building, plant and machinery, furniture, equipment, making less accumulated depreciation is equal to net fixed assets. Easy? All of you easy? Understood the turnover ratios. All turnover means sales. Turnover ratios means sales. Keep in mind. Turnover means sales. How to improve the sales? How to improve the collections from the sales? Convert the sales into cash. Fixed assets turnover ratio measures the efficiency of assets utilization. It shows how the management using the fixed assets to generate the revenue. Indicates the operational performance. Higher the ratio reflects effective utilization of plant and machinery. Helps in capital investment decision. Management can assess whether the additional investment in fixed assets are required or no need to invest in the fixed assets. Assist the investors and creditors. It provides the insight into the productivity and efficiency of a long-term investments. Evaluate the capacity utilization. Very good question. Very good point. A ratio indicates whether the fixed assets are underutilized or overutilized. Idle fixed assets ratio is equal to around 5 times. A ratio of approximately 5 times is generally considered satisfactory. However, the actual figure may vary from industry to other industries. Interpretation: high fixed assets turnover ratio, better utilization of fixed assets. efficient production capacity, higher sales generation from investment in fixed assets, strong operational efficiency, lower the fixed assets turnover ratio, underutilization of assets, excess investments invested in fixed assets, idle production capacity, lower operational efficiency. Please calculate. Net sales divided by net fixed assets. Net fixed asset is equals to gross assets minus accumulated depreciation. Five times. All of you got the answer.
Yes, sir.
Yes,
5
sir.
times.
So company generating $5 of sales for every $1 invested in fixed assets. Means if we invest $1, they will get the sales $5. Total assets turnover ratio. Total assets turnover ratio. So the total assets turnover ratio measures the efficiency with which a company utilizes its total assets to generate sales. Total assets. Fixed asset net sales by net fixed assets. Net sales by total assets. It will give the relationship between net sales and the total assets. Net sales divided by total assets. Net sales divided by the net fixed assets. Net sales divided by the working capital. Components of total assets, non-current assets and current assets. Net fixed assets, investments, intangible assets. Current assets, inventory, trade, capital, and short-term notes. Exclusions from the total assets, very important point. We discussed in the leverage ratios also. Fictitious assets should not be included, such as preliminary expenses, discount on issue of shares, profit and loss, debit balance means loss, deferred revenue expense. Note, some analysis excludes investments from total assets because they are not directly employed in the business operations. However, unless specially stated otherwise, investment should be included while calculating the total assets turnover ratio. Importance of the total turnover. It measures it evaluates the efficiency with which the total resources are employed to generate a sales. Indicates the asset utilization, shows whether the assets are being utilized productively. Assets management is determined whether the additional assets are required. Useful for investors and the creditors. Provide the significance into operational efficiency and management performance. Measures returns on investments. The higher ratio means the better utilization of investments in the business. Ideal ratio is 2 times. Higher the total turnover ratio is efficiency utilization of total assets. Higher operational efficiency, better management performance, greater sales generated. Lower the turnover ratios, utilization of assets, excessive investment in assets, lower productivity and identify things.
Sir, one doubt, sir. One doubt. Sir, you said as this net sales means it's COGS, cost of goods sold. So
No,
this
no,
all
no.
means in the
Okay.
working, sir, because as if it's all net sales, see, if it is fixed asset, it's net sales divided by net fixed assets, and this turnover, this total assets turnover ratio, it's also net sales divided by total assets.
Yes.
And working capital turnover is COGS or net sales divided by working capital.
Yes.
Means COGS means it is the net sales. So for this
No,
fixed
no.
asset and
No. How you can say the COGS are different and the net sales are different, brother? If it is both are equal, your profit is zero.
yeah, that only I'm asking, sir. Both are equal, it's zero.
Sometimes the scenario, the questions will give alternatively. Sometimes working capital, depends upon the current assets and current liabilities, right?
Yes.
Interpretation: the company generates 2 times of sales for every $1 invested in total assets. So this material I will share with you. I given one full question, given the profit and loss account and the balance sheet of Tarun Limited. You are required to calculate the important turnover ratio. I said turnover ratios. So I given you the profit and loss account. I given you the balance sheet also. See, I given you everything. Gross sales, sales return, net sales, purchase, administrative expenses, net profit I given, opening inventory I given, closing inventory I given, cash purchase I given, trade purchases I given. Okay. And here I given you the balance sheet as well. I given you the balance sheet as well. Share capital, reserves, debentures, trade payable, bills payable, bills payable, provisions, building, plant, trade investments, inventories, trade receivable, minus provision for doubtful debts. You will take provision for doubtful debts? No. We need the net debtors, right? Net trade receivables and the bills receivables, then the provisions they are giving. Interesting problem. Try to solve all the turnover ratios and please post the answer into the group. I will give the material and Alhamdulillah, we successfully completed on time the activity turnover ratios. We hope this session on activity turnover ratios has enhanced your understanding and learning. Okay. Numbers tells the story. Ratios reveals the performance. Analysis drives the better decisions. Beautiful caption. Numbers tells the story. Ratios reveals the performance. Analysis drives better decision. If you not analyze, you must analyze your day-to-day performance for CMA examination. That will help you to take a proper decision, how much time you have to invest, where you are going wrong, where you need to focus. If you are not analyzing your performance on daily basis, you will be in the wrong opinion that I will pass my CMA. You must analyze. Yesterday I completed this much of time I given. Tomorrow I will give like this, like that, like this. Key takeaways, what you are taking today after the session. Activity ratio measures operational efficiency. They help in evaluating the performance and identifying improvement areas. Effective management of resources improves the profitability and the liquidity. Ratio analysis supports better planning and decision making. So next session, we'll understand the general profitability ratios. Okay, measures the profitability of a business from normal operations using the key ratios, and our overall profitability ratios, evaluating the overall performance by considering all the factors affecting the profitability. And very, very, very important. In this question, I given the profit and loss account, I given the balance sheet, I'm asking you the ratios. And when you in the next session, we'll understand preparation of the financial statements from the ratios. If you reach this position, 25%, this chapter, why I started, why I am investing this much of time, why I am going this much slow, means the 25% weightage will come from these ratios in the examination. That's why I'm investing, I'm taking personal efforts, I'm putting a lot of personal efforts to at least we must have a control, strong control in the exam, at least 60 to 75%. We should be enough capable to crack the exam. How much percentage of marks is required to pass CMA? Girish? Like Indian Chartered Accountancy, 50%, right? Chaitanya? Chaitanya, what is the percentage of passing marks for CMA? Faiz? Mushraf?
360, sir, out of 500.
Out of 500, 360. What is the percentage?
72, sir.
Is it correct, Girish?
72%, yeah, it's correct. So 70% is. I think so, sir.
How many percentage you need to pass CMA? Okay. Faiz, what is the percentage of marks you require to pass?
$360 out of
360 out of 500 or 700? With the answer in the next session. So here, preparation of the financial statements from the ratios means from the balance sheet, we learn how to prepare the ratios. From the ratios, how to build the balance sheet reversible. So inshallah, next class also we'll enjoy and we'll try to simplify the ratios. Lot of efforts we are putting. So utilize our efforts and show the results, please. So have a good night. Thank you very much.
Thank you, sir. Thank you.
Thank you, sir.
Thank you. And Muhammad Kashif. Yes, sir. How are you understanding the classes, Kashif? Azam, can you speak? Okay, thank you. See you in the next session. The profitability issues. And that will be the end of ratio analysis. We are going to close the ratio analysis chapter in the next session.